The market's getting pretty oversold at this point. It's obviously 5% correction is starting to get people pretty nervous. We're seeing the VIX elevated, put call ratio elevated, meaning people are betting leverage on the downside. I think this market is about ready for some type of bounce or pause, and now the market's resetting. But the general public is very fearful. So people are betting on falling prices, and this is a market top. So it really depends on the group you're talking about, but I can feel fear. People are getting very nervous right now.
The slide in U.S. equities over the past 3 weeks was the start of a sell-off that is likely to deepen along with mounting macroeconomic risks, including rising treasury yields, a strong dollar, and elevated oil prices. Markets are oversold in the short term, says Chris Vermeulen, chief market strategist of the technicaltraders.com. Vermeulen notes the typical stair-stepping action of the market, both upwards and downwards, indicating that it's primed for a potential bounce. The first sharp pullback for U.S. stocks in half a year is leaving investors wondering whether to buy the dip or hold out for more declines. Following several turbulent weeks, the S&P 500 is down more than 5% from its March 28th closing high, its biggest retreat since October. Though they have been rare in recent months, such drops are not uncommon. The S&P 500 has experienced an average of 3 pullbacks of 5% or more every year since 1929, a Bank of America analysis showed. Regarding the current pullback in the S&P 500, Vermeulen sees it as fairly controlled, suggesting the potential for a sharp knee-jerk reaction bounce. He speculates that this may be a strategy to shake investors out of the sell in May and go away mentality, potentially leading to a rally going into May. Stocks rebounded from their recent slump on Monday, but some bearish Wall Street strategists still see concerns that aren't going away anytime soon for investors. Vermeulen highlights the importance of monitoring how different sectors and commodities respond in the upcoming weeks to assess market sentiment accurately. Observing the performance of precious metals, utilities, the dollar, as well as small caps and dividend stocks, will offer valuable insights into investor behavior. Let's delve into the video to gain further insights.
The market's getting pretty oversold at this point. It's obviously 5% correction is starting to get people pretty nervous. We're seeing the VIX elevated, put call ratio elevated, meaning people are betting leverage on the downside. I think this market is about ready for some type of bounce or pause. I don't know if it's going to have a lot of life behind it. It's really tough to say until we see what type of chart pattern unfolds over the next potentially next week or two, if it has a bearish vibe or a bullish vibe. But overall, the market always has a stair-stepping action up and stair-stepping action down. So I do feel like it's primed and ready for a bounce. And the question is it the bounce or is it a bottom and we continue to rally into May or into the election? Again, I can't tell you what's going to happen yet, but we definitely need to see how this fear plays out. Does it turn into a big wave of distribution selling and a lot more volume, or is it really just the first bout of big profit taking and trying to shake out a few short-term traders? We get a real feel if this market is going to go a whole lot lower or if this is just a pullback. It is a fairly controlled pullback, the overall stock market. When we look at the SP 500, this is a fairly sharp pullback, but it actually seems very controlled, and it's the type of pullback that can have a very sharp knee-jerk reaction bounce and keep going. And there's that kind of mentality you and I talked about, I think last month, about potentially sell in May and go away. I think this is a little bit of a shakeup, trying to buck people out of this bull market move. And we might actually rally and push higher going into May still. Pretty sharp pullback. If we take a look at just on average, some of these, that was 7%. This one is a little bit more, 8%. All of these pullbacks are generally 5, 6, 7, 8, somewhere.
How long does it usually in the past take to correct by those percentages?
I mean, it really depends on the stage, the way the market is in. This is a very normal pullback. This type of pullback usually has one of these bounces after it, a sharp bounce. And the big question right now is it one of these bounces, which is going to have a fairly decent move, or is it like something that's going to push to new highs? Like, could we see it just have a V shape and continue to go higher? But overall, I mean, we really need to see how this is going to react and how a lot of different sectors and commodities react during the next couple of weeks. So once the market starts to bounce or find stability or trade sideways, at least, what are precious metals doing? What are utilities doing? What's the dollar doing? What are small caps and large caps and dividend stocks doing? We take all those into effect. We can get an idea of what the general masses, the big money flows are doing. And then we can figure out, is money aggressive in actually moving back in to try and play another move higher? or is this just a bounce and people are actually starting to sell off aggressive stocks and move to more defensive plays and dividend plays, things like that. So, I mean, it's really hard to answer how long it's going to take, but looking at this chart, it usually from this point here, we could see, potentially a peak and a bounce, 2 weeks from now. So we might see higher prices 2 weeks from now. And then the question is that a peak and we're going lower, or is it going to build a launch pad to go higher?
So
and that's what we need to see. If we pull up the VIX real quick, today, the VIX had a huge pop in the last trading session. If I zoom back a little bit, you can see it's popped way up into the nosebleed section. Last time we got up here, the market had a very significant low. And so we're seeing that. We're seeing a lot of fear at a point when the VIX is high, it's time to buy, is the saying. And when everybody's fearful and dumping shares, that usually means, okay, the market's ready for a bounce because most people have just panicked and they've dumped their shares, which is why price fell so quickly. And now we should have a bounce. The question is bounce or the beginning of a new rally. And nobody will know that until it takes place. So we just need a strong enough bounce to get price above the moving averages. And then if things firm up, we can hop on board and see if that new trend has got legs behind it.
According to Chris Vermeulen, there appears to be significant fear in the market currently. When fear dominates the stock market, the dollar tends to perform well. The US dollar index, which measures the value of the US dollar relative to a basket of foreign currencies that includes the euro, British pound, and Japanese yen, has gained by more than 1% so far in April, reaching 106.151 as of the close of Thursday last week, from 105.019 on April 1st. Furthermore, Vermeulen articulates an investment philosophy that rejects the idea of diversification. Instead, he champions the strategy of maintaining assets with sustained value growth. Drawing an analogy to ocean tides, Vermeulen suggests that a rising tide indicates favorable conditions for stocks, whereas a receding tide signals the need to transition to alternative assets. Now let's redirect our attention to a video.
I think there's a lot of fear in the market. When the stock market's got a lot of fear, we tend to see the dollar do well. And I think we got enough global fear going on that gold is also, people go to it as well, and they're both moving up. I mean, we got wars going on. A lot of people are nervous about stuff. So I think the dollar is going to do very well. I think it'll eventually, the big rise in the dollar, I think later this year, potentially it will mute gold. Probably when gold hits 26 or 2,700, the dollar will probably start really rocketing higher and kind of neutralize it to some regard. But yeah, it's interesting. They have been moving up together, and it's funny. I like them both. Yet everybody's like, well, you can't own both. They do the opposite. I'm like, not always. Right now seems to be the window where I like the dollar. We're actually getting pretty close to wanting to get into the US dollar as a long-term play, like UUP, which is just the dollar index ETF. And the way I look at the markets is I don't believe in diversification. I don't believe in holding a whole bunch of assets that, when the markets get hit, some might go up, some are going to go down. You end up with a really average return. So my belief is I only want to hold assets that are going up. If they're not going up, I want to move to a different asset that's going up. And I like to look at the market like the ocean in terms of if we have a rising tide and the tide is going up, we want to own stocks. We want to focus on a stock market strategy. If the tide is going down, we want to focus on owning different assets and get out of the stock market. And right now we're kind of back still in this rising tide mentality where we want to be in. And so understanding what direction the underlying market is doing gives us kind of that insight of how we want to attack these markets. And then we go into a shorter term strategy where we trade the index ETFs, we trade bonds, the dollar index, bill, which is like a treasury note, a dividend paying monthly dividend. And so we actively navigate through these markets to make sure we're owning things when they're going up, where when the market's red or down, we're holding the US dollar index or something else that's going up in value. And so we actively just rotate through the market. There's generally about 5 to 12 trades a year. We pretty much have 1 or 2 ETFs open at a time, one position generally, which is like the stock market. And as we scale out, we move into a bill, which is like a cash dividend, monthly dividend. So it's a very different strategy where we want to be able to move our entire portfolio in and out of positions just enough to catch these waves in the market and navigate it that way. And it works in retirement accounts and all those things. We just moved into cash last week. So we're 100% in cash right now, collecting dividends in a bill. So we're collecting like, 4.5% broken up through monthly dividends right now until we get a new opportunity to benefit from falling prices or to get back long if this market turns around. That I'm making, 4.5% a year minus everything else inflation. I'd rather hold something making 4% than hold something that falls 15 or 20%. And if you're just constantly always in things going up in value, I mean, we don't have to swing for the fences because we're constantly hitting first, second, third base hits, and we're not taking any big losses. And that's the real key. Is I don't look at it like some people say, well, I don't want to go to cash, I'm losing money. It's like 2%, as you said. Well, it's way better to make 2% than it is to lose 8% or 5% in a couple of weeks, like on the SP 500 or the stock and bond portfolio, which is down really sharply as well. So you have to stop thinking about like, I got to beat inflation, and just start thinking like, I don't want to ride things down. I just want to hold things going up. And everything changes when you focus on that. It's like the markets become much more relaxed when you understand how to identify these.
History shows that strong starts to a year are often followed by sizable retreats, after which the stock market typically rights itself and continues higher. Many market participants believe the factors that drove the S&P 500 to a 10% gain in the first quarter, including resilient economic growth and excitement over artificial intelligence, remain in place and will support stocks over the long term. What are the best stocks to buy right now? Is it time to sell your stocks? Feel free to share your thoughts in the comments.